one of the things I was curious about, I wanted to sort of get a sense of what is real estate and why, in fact, why do we call it real estate? So I did some research on it, and apparently at least one explanation is it comes from two Latin words, the first one being realis, meaning actual existing, and the other one being stare, a Latin verb for to be. Status, standing, a measure of wealth. So when we think about real estate, we have a lot of categories. We have commercial, industrial, we have farmland, we have housing. And one of the things I wanted to get a sense of is, well, how big is this actual marketplace? So about a year ago, a company called Savills did an analysis of our global wealth. What does that look like? And it's a pretty big number. It's over about $400 trillion US, of which 228 trillion of that is in real estate. And if I take away the housing, there's going to be a significant difference, but the equity markets, this is all global equity markets, are about $70 trillion. Investable real estate, about $100 trillion. So if we change that and look at it as a percent, it looks something like this. We have about 20% in multifamily, 11% in commercial, farm and timber, 11%, 23% public equities, 33% fixed income or public debt, and gold, a very small sliver at 2%. So 42% of investable assets are real estate. So it raises an interesting question. Why would anybody have a portfolio where 60 to 75% of their assets were in equities, publicly traded equities, if it's 23% of investable assets? So here's some data going back. You know, I like to data mine, and this data goes way back. So for some reason, a group of economists had nothing else to do, so they decided to do research on various asset classes' performance over the last 145 years. So that's a long retirement period, of course, and they took a look at 15 different countries, including Australia, Canada, Belgium, the UK, and they took a look at T-bills, they took a look at bonds, they took a look at stocks, and they took a look at housing, but in this case they mean income producing or commercial housing. So what were the end results? Well, as you could expect, T-bills would have the lowest return, 4.6%, and the second bar you're looking at is the volatility. So the lower that number is, the lower your risk is, 3.3%. Bonds, better return, greater risk. Real estate, greater return by a significant margin over bonds, and more risk, although not necessarily significantly more risk. When we look at equities, we find a very similar return and a much larger volatility. Same return, more or less, over a long period of time, about half the risk. So the question is real estate really half the risk of equities? Well, if it wasn't for these two things, it would be the same: liquidity and behavior. So unfortunately, the very fact that you can buy and sell securities on a daily basis begs for bad behavior from investors. So when markets drop, like they did towards the end of last year, people panic. Once they get into a fear mode, they get into something called loss aversion. So they worry and they get more and more cautious the worse markets get. So that makes the idea of buying low and selling high extremely difficult. And they get euphoric when markets are rising. So of course that means their emotions are the opposite of what's required to be a really good investor. And that would explain most of the difference in the volatility between stocks and real estate. Now, when it comes to economics, and a lot of this we're going to take a look at some forecasts going ahead. There's an interesting comment I read somewhere. This is what it says. It says, the science of explaining tomorrow, this is economics, why the predictions you made yesterday aren't coming true today. And I think that that's probably true. And economists get a bad rub. And one of the best magazines, for me at least, in terms of data on economics and finance is The Economist magazine itself. And about a year ago, it came out with this very interesting chart. So somebody had actually gone back, again, roughly about 150 years, and said, here's what happens to your returns in a balanced portfolio. By balance, they mean 60% stocks, 40% bonds. In the 10 years following a certain set of conditions in the marketplace. The only thing that matters here is this part right there, which is more or less today. In other words, what they're saying is the expected return you can look at after inflation is going to be 2% a year in a balanced portfolio. And that's because of the price of the asset classes and where they are today. So it's going to be very difficult when you're starting. If you think about it, it's sort of like going into a casino and they've changed the odds on blackjack so the house gets an extra 10% on top of what they're already getting. And you're still trying to win that game. So let's take a look going back, in this case almost 20 years, to January 2000. S&P 500, the TSX, and an index called IPD. Now, most of you aren't familiar with this index, but institutional real estate investors in Canada submit data to IPD and in 25 other countries about all the real estate that they buy, the returns, the income that they earn on the properties, and IPD collects all of this data. We're a member of IPD, and then puts together an index about how real estate is performing, geographically and also by sub-asset class. So how did it look over the last 20 years? Well, interestingly, when we look at just the price appreciation of the equity markets and real estate, they're virtually identical. But when we look at the total return, there's a big gap. And that big gap is caused by the difference between the cash flow that one generates on real estate and the cash flow that one generates on stocks, especially when we were going back to January 2000. So let's convert that into dollars and cents. $1 million invested in January 2000. Today, in the equity markets would be worth roughly the same in US or Canada, $3 million, but it would be worth $6 million if it had been invested in simply a portfolio of investment-grade commercial, industrial, multifamily, residential housing. So let's look at it from a different perspective. Why is this being caused? If we look at the cash flow, so $1 million back in 2000 generated about $11,200 of income on the S&P 500, and today it's $50,000. So that's a very healthy increase in the cash flow in the portfolio. Interestingly, not as good as it would have been in the TSX, which started at 12 and ended up at 85. But both of them pale in comparison to the cash flow that started at $78,000 for the real estate index on $1 million of capital, and today is about $250,000 a year. So that's the difference, is that real estate is not necessarily going to appreciate even as fast as equities if all we're looking at is price. But when we're looking at this from a different perspective, which is cash flow, all of a sudden the numbers change dramatically. Another way of looking at it is from a volatility perspective. What's the volatility of price? When we take a look at the equity markets, both Canadian and US equity markets have a significantly higher volatility than that same real estate index, about a 4-to-1 difference. When we take a look at the volatility of price, of income, I should say, for all three indexes, they're a fraction of the volatility of the price. In fact, on average, price is 6 times more volatile than dividends. So here's a question for all of you to think about. Are you more aware of the price of your portfolio or its income? So think about that from this perspective. Your statement comes in. What's the first thing you look at? What is your account worth, which is the price? And while we do publish cash flows for our clients so they can see the cash flows, most of the time when I take a look at financial statements, investor statements, I cannot find the cash flow. I have no idea what it is. Yet the actual definition of value and the thing I'm looking to acquire here is I'm looking to acquire cash flow at a reasonable price. So interestingly, if I can get the emotion out of the marketplace, when the equity markets dropped 20%, give or take, towards the end of last year, the dividend income on the equity markets didn't change at all, didn't drop at all. In fact, in some cases, it went up, which meant that the market was saying, I'm giving you this opportunity to buy 20% you get 20% more income for exactly the same amount of capital. So that would not be a reason to be fearful. That would be something you would hope to see on a regular basis, because most of you are going to be net buyers of assets for the rest of your lives. You're not likely to be net sellers. All right, so let's take a look at how this plays out between the public and private markets. This is the TSX REIT index, and I'm comparing it to that same IPD index. When it comes to a rate of return, over the last 20 years, or 18, 19 years, there virtually is no difference between investing in a REIT portfolio or investing as per IPD. But let's take a look at how we get there. The best year for REITs was plus 50%, roughly in 2007. The best year for the IPD index, 17%. The worst year was minus 42% for the REIT index, minus 2% for IPD. Now you have to remember, both the REIT index and IPD represent organizations that are holding more or less the same real estate. So the reason for this difference in volatility has got nothing to do with either the REITs or the institutional asset owners that are represented by IPD. It has to do with investor behavior. So let's take a look at, one of the Bibles for me of financial planning and advice is CNN. And I went there just to get some advice about what I should do for asset allocation. So you have to answer this questionnaire. It's a little hard to read on the screen, so I'll read it for you. So when do you need the money? I said 10 to 20 years. How much risk can you handle? I said, reasonable amount. How flexible are you? Now, I said I was reasonably flexible. Now, according to my wife, Claire, and my trainer, that's not true. But notwithstanding that, I put that in there. And then what would I do if the market dropped? I said I would do nothing. Now, according to them, based on those questions, my asset mix should be roughly 35% large cap stocks, 20% foreign, 20% small cap, 25% fixed income, 75% stocks, no real estate, and that's with me being medium risk and somewhat flexible. Let's take a look at where we are today. And I'm relating this to equity markets because of expected future returns. What you're looking at here is called the Cape-Shiller Index. It represents the trailing 10-year PEs of the S&P 500 going back, again, about 120 or 30 years. And what you're looking at is a variety of peaks. Now, if we take a look at 2018, the peak we saw last year, roughly at the end of the summer, that peak was higher than 1929, only beaten by the really high PE multiples of the dot-com era. So let's see if we can translate this into something. I decided to take a look and say, all right, let's take a portfolio from each of those points and look forward 5 years. We're going to put 60% in the S&P 500, 40% in bonds. How do we do after fees and after inflation in the next 5 years? And we have the following results. In most cases, the returns are either zero or slightly negative. The average return, slightly negative. So that means if you have a goal of getting a 4% real rate of return net of inflation, you're going to be short significantly. You're starting with a position that has a likelihood of getting a 0% return for the next 5 years. The kind of definition of treading water, I sort of feel for this cat. So one of the things when you're investing is to try to invest in such a way as to increase the probability that your outcomes aren't going to look like this. So if we take a look at high net worth investors, you can get this report. It's free online. This is the latest high net worth report from Capgemini for 2018. And it says, what's their allocation to real estate? 16% across the board. What's their allocation to equities? 30%. It's been between 25 and 30% for the last 10 years. And how are pensions investing? And David alluded to this about how pensions invest money. Well, when we take a look at the Canada Pension Plan, their allocation to equities is only 39%. When we take a look at arguably an even better managed pension plan, which is Ontario Teachers, their allocation to Canada is only 45%. Two issues here. the allocation to publicly traded equities, and the allocation to Canada, since we're a relatively small part of the investable world. So our asset allocation, which we've had for a long time, has been broken down into real estate, about 25%, equities, public and private, about a third, about the same percentage in fixed income, bonds, mortgages, and private debt, and an allocation to alternative strategies, including some hedge funds and precious metals. The real estate allocation looks something like this. For us, 50% of our real estate assets are in the US in income-producing assets, a third in Canada, both income-producing and assets that we're building to own, and Mark will go over that a little bit more later. And value add is the development. So we have a development pool for the last 5 years. I'll explain some of the returns in just a second, and that's about 15% of our total. So when we take a look at this approach, like, has it helped our clients? David explained our long-term returns, but the key is, how do those returns stack up when you're under pressure? So the two times that we can measure when there were prior peaks, 2000 and 2008. If we take a look at the 5 years after that, this is the 60-40 performance 5 years after 2000, minus 2% a year, against 5.1% for our clients. It was 0 in 2008 to 2013 for balanced portfolios against 3.1. So when we weight them together, they're exactly where we want them to be, which is the 4% real rate of return, net of fees and inflation. All right, so we have 3 real estate pools. All of this information is on our website. The grandfather pool is Spire Canada, and it's been around for almost 14 years. It's earned a 9.5% year rate of return. Roughly, assets have tripled, a little bit better than that over that period of time. We started investing in the US in 2007, and we made that a separate pool in 2010. And that pool has done even better, 11% a year, and 14% a year thanks to a depreciating Canadian dollar. And finally, our development fund, Spire Value Add, has only been around 4.5 years, and it has done extremely well at 15.7% a year. I make a note here that we have a little less than 50% in residential. If there's an area that can be a concern going into the future, it could easily be this area. So, normally when I have a chance to present or speak, I try to start with the bad news first and end up with some happy news at the end. Unfortunately, tonight, I won't be doing that. So, low-hanging fruit. What do I mean by that? Well, if you took all of the different ways you can invest money, there are 3 primary categories. You either lend money to people and collect interest, you own real estate and collect rents, or you own a public or private company and you collect a percentage of the profits. And those represent by far most of the world's wealth. So let's take a look. Right now, interest rates, US 10-year bond rates, are virtually 0% when adjusted for inflation. They should be more than 2%, but they're not. So what will the impact be on returns on bonds as they try to work their way back up to that level? We've already seen how expensive equity markets are. And real estate has had a great run, but cap rates are the lowest they've been this entire century. So the question is, it's getting harder to find good low-hanging fruit. So what does it mean for us in terms of our approaches? We're going to have to do a lot of extra work, I think, in the next 5 or 10 years. And I would expect that to be a really challenging period of time for traditional returns. So in the area of fixed income, using more private debt, corporate lending, and mortgages to get a value-added coupon over and above that which you might expect from, say, corporate bonds. In the area of equities, making sure the asset allocation is right, as in staying around 30 to 35%, looking at covered writing, value investing, dividend growth stocks. And in real estate, we simply won't be able to buy a building and hope that just by collecting their rents, we're going to get a double-digit rate of return. We're going to have to look at value add, build to own, and also be very careful about the level of leverage we have. And in our case, our current leverage on both income funds together is about 50%. So not that high. So take this time now to introduce my colleague and partner, Mark Hanna. So Mark spent many years at Avison & Young. He became managing director of Avison & Young. But in 2014, Mark's worked with us pretty well since 2001, 2002. But in 2014, we were able to get him to leave the dark side and come over and join us. And he's now our managing director of real estate. So he's come to the light, the force is with him, and he's going to be your host for the rest of the evening with a very esteemed panel. So please welcome Mark Hanna.